Hello everyone, it's Friday, April 11, and today we'll take a closer look at the euro and the British pound charts to assess potential market shifts. On Thursday, the euro gained strong upside momentum, climbing back above the 1.1000 mark. During the Asian session today, the rally extended, signaling renewed appetite for risky assets. The move was driven by softer-than-expected US inflation data, which reshaped market expectations for monetary policy. The Consumer Price Index declined by 0.1% month-on-month in March, defying forecast of a 0.1% increase. On a yearly basis, the CPI came in at 2.4%, down from 2.8% in February. Core inflation rose just 0.1%, missing the 0.3% estimate, while annual core CPI inflation eased to 2.8% in March from 3.1% a month ago. The data offered relief to the Federal Reserve and opened the door for a potential rate cut at the May meeting. While the likelihood remains low for now, a rate reduction during the summer appears increasingly probable, especially after President Donald Trump announced a 90-day pause on tariffs. This macroeconomic backdrop allows the Federal Reserve to stick with its previously signaled course. Yet it has put pressure on the dollar, helping both the euro and the pound strengthening. Market reaction to Thursday's Fed commentary was muted. Officials reiterated the need for caution in future policy moves, emphasizing that the battle against inflation is not over, particularly in the face of Trump's escalating trade war. Notably, the US president ratcheted up tariffs on Chinese imports, raising them to 145% from 125%. Trump appears to be holding out for Beijing to make the first move, while China remains firm in its stance to fight to the end, continuing to impose retaliatory tariffs in an effort to stimulate local economic growth. All signs suggest the trade war is far from over. From the Fed, this reinforces the need to look ahead, likely by easing monetary policy. That outlook is quickly becoming the central scenario priced in by currency markets. Before diving into the technical analysis, let's first take a look at today's macroeconomic calendar. The focus will be on UK GDP data, with the British economy estimated to have expanded by 0.1% in February, following a 0.1% contraction the previous month. Stronger-than-expected growth could lend additional support to the pound and extend its bullish momentum. The UK is also due to release figures on industrial production and trade balance. Upbeat results would likely provide further upside for sterling. In the Eurozone, attention turns to Germany's Consumer Price Index. The CPI is forecast to rise by 0.3% month-on-month and 2.3% year-on-year. Signs of easing inflationary pressure would give the European Central Bank more room to maintain its current policy trajectory. While this may not offer a direct boost to the euro, the overall macro backdrop appears favorable for the single currency. As for US statistics, producer price data will be closely watched. The PPI is expected to have increased by 0.2% on the monthly basis and 3.3% annually. A weaker-than-expected forecast reading would add to the downward pressure on the US dollar, offering further support to risky assets. Later in the session, the University of Michigan will release key data on consumer sentiment, inflation expectations, and current conditions. Traders may also take notice of a speech by Fed officials John Williams. However, with no change in tone expected, his remarks are unlikely to spark any major market reaction. Let's now turn to technical analysis. The 1 hour shows that the euro-dollar pair has already gained 200 pips during the Asian session, making it too risky to buy at current highs. Long positions should be considered on pullbacks. A false breakout at 1.1282 would generate a buy signal, paving the way for a move towards 1.1336. If the price breaks through and consolidates above this level, the euro-dollar pair would climb to 1.1388, potentially reaching 1.1427 and even 1454. At this mark, I would recommend going short on a rebound, targeting a 35-40 pip intraday correction. Short positions at 1.1336 and 1388 should only be considered in the event of a false breakout. Alternatively, if the price breaks below 1.1282 and holds there, the euro could give back some of its early gains and retreat towards 1.1217, with 1.1155 acting as the most distant target. At this level, long positions on rebound would be justified, aiming for a 35-40 pip intraday correction. Going long at 1.1217 and 1282 would be relevant on the false breakout. Speaking of the British pound, it has also gained strong upside momentum, signaling an end to the bearish trend that began on April 3. A pullback followed by a false breakout at 1.2986 would generate a buy signal, potentially lifting sterling to 30.47. A break and consolidation above this level would likely extend the bullish run towards 31.08, with a possible push to 1.3156. At this level, traders are advised to consider short positions on a rebound, targeting an intraday correction of 35-40 pips. Short positions at 1.3047 and 31.08 should only be opened after a confirmed false breakout. And the bearish case scenario, break below 29.86 could drag the pound and sterling lower to 29.29, opening the path to 28.66. At this mark, long positions on rebound would be justified, aiming for 35-40 pip move. Going long at 29.29 and 29.86 should be considered only in event of a false breakout. Good luck to all and have a nice weekend.